This video covers Chapter 1. It basically follows the outline of my notes, which are on Blackboard, and I like to label this presentation as being concise, a concise presentation of Chapter 1. It's going to cover returns, risk, and risk and returns, and then you'll better understand that as I unpack this chapter. But the point is, I use the word concise for a good reason. I find that there's a lot of extra baggage in Chapter 1 in the textbook, and I want to get right to the heart of matters. And that's what I'm going to do in this video and in my notes. So the first thing we want to do is we're going to talk about returns, and we're going to talk about risk, and I'm going to use a table of data to help with the examples. So I got this data in this table, and this is real data, and I'll explain what I mean by that a little later. But these are total returns, and I'll explain what a total return is in a minute. But I have 4 years worth of data. I have large company returns, and by large company I mean large market capitalization, and market capitalization is nothing but the price of a share of stock times the number of shares outstanding. So it's a measure of what we call capitalization, and I just call it large cap, and that's basically the way the industry refers to it. So we got large cap stocks had a 23% return in year 1, 33.4, that's a 0.4 here, in year 2, 28.6, and so on. The average, the arithmetic average, as I'll explain a little later, is 26.5%. And we also had the returns for long-term government bonds, T-bonds. T-bonds are usually issued by the U.S. government with a maturity of 10 to 30 years. And so the return in year 1 was only 0.1%, and then year 2, 12%, and overall the average for this 4-year period was only 4.8%. There's also Treasury bill returns here for 4 years, and Treasury bill returns are, again, these are total returns, and they represent the return from very short-term government instruments that are sold at a discount, and I'll explain, and that'll pop up later on in the course exactly what that represents. But this is the risk-free rate. This is the risk-free rate, and it's fairly stable, as you can see, and the average turns out to be 5%. So this is the table I'm going to use in the examples when I start to go over some definitions of returns and definitions of risk, and when I combined risk and return, most of my stuff will apply to this problem, to this table. Okay. First thing we want to look at is the components, the total return. So total return of any investment is composed of two components. It's composed of a capital gain or a loss, which is really price appreciation or depreciation, plus some type of cash flow that the instrument throws off or generates. And cash flow, it sounds generic, but cash flow, I mean, if we're looking at the total return for a stock, the stock price can go up or down, so you have a capital gain or loss, but you could also have dividends, and so that would be the cash flow associated with it. If we were looking at a bond, and you bought a bond, your total return would be, look, I bought the bond for $900, it went to $950, so I have a $50 return, and you would put that into a percentage form, and then you'd also have coupon income on this, and the coupon would represent the cash flow. Okay? So this total return formula here that I have, it works for any asset. I don't care what it is. It could be that at times the cash flow is 0, but this formula overall works. It even works if you consider an apartment building. You buy an apartment building, and your total return for the apartment building over a period of time would be measured by, how much did the property appreciate or depreciate in value, and what did the real estate value change by, and then also your cash flow. And your cash flow would be net in this example. It'd be, your rent income minus your cost of upkeep and maintenance of the property. So this total return is a very valuable and useful thing in finance. That's what we want in finance. We want to look at total returns. And the point is, there's only these two components. There's no other component to a total return, just these two. So now, what we want to do is we want to talk about holding period returns, because the textbook talks about holding period returns. It's fairly common terminology, and I'll call it HPR for holding period return. And so let's define that, and then we'll just do a simple calculation. So you have a holding period return. It's nothing but the market value of your investment at the end of the period. Okay, market value ending, I'll say, of your investment, plus the cash flow that you get from the investment at the end of the period. So this should be also ending, divided by your market value at the beginning of your investment. And so basically what we're doing here is we have a timeline. So we're almost, in this class, we almost always start at time 0. And so you make your beginning investment, the market value, you plop down some money to make an investment at time 0, and then you ask, well, how much money do you have at the end? And we're going to assume the cash flow, the dividend or the coupons come in at the end of the period, just a simplifying assumption, and we're looking at the market value at that ending period. And so this sometimes is called a gross return, because it's going to show you, this holding period return will show you not only your incremental income that you get from this, but also return of principal. Your textbook also talks about a holding period yield, okay, which is not that common. I'm just doing it to be consistent with the text. As far as I know, it doesn't really refer to holding period yield for the rest of the textbook. But they're just referring to a holding period yield as being your holding period return minus 1. And so what this does is this is really going to measure your income component. And let me just give you a quick example. Let's say you bought a stock. Let's say you have a stock and you paid, so you want to calculate the holding period return. And the stock that you paid $10 for it. Okay? So that's your beginning investment, $10. And I'm doing it all on a per share basis. The stock goes up to $11, so that's your ending value. Okay? And then you have cash flow. Maybe you got a $1 dividend in that time period. And so this would be 12 over 10, which equals 1.20, right? And so this is sometimes called your gross return. The 1 stands for the return of your investment. You got your $10. You sunk $10 in here. You got your $10 back here, plus you got a capital gain component of 10%. So the capital gain component. So you have a total return of $1 in terms of cap gain, right, out of 10. Plus you have a $1 cash flow out of 10. And so you got a total return of 10% plus 10%. Okay, that is a total of 20%. And so to match this up with your total return, you get this 20% component. This is your holding period return. And your textbook is calling the holding period yield to be this guy right here, 20%. I don't like this terminology. Like I said, it doesn't really show up. So I'm not worried about if you know holding period yield. Just look at the holding period return and know what the total return is. Okay. This, by the way, should be a review from your previous finance course. I shouldn't be showing you anything new here. Maybe the terminology is ever so slightly different. The formulas may be ever so slightly different in terms of symbols, but the concepts should be identical to what you've learned in the previous finance course. The prerequisite to this MBA 627. Now, let's talk about two types of averages, average returns. And so there's two types. First is an arithmetic average return. And that's fairly straightforward, but symbolically, maybe not too symbolically, may not be too straightforward for you, but it's an expected return, and we're going to label it expected return, and you can put an R bar over that, meaning an average, like you may have done in your statistics class, and that's going to be the sum of the returns over time divided by n periods. And that's not too hard. So if we were to calculate the expected return for large company stocks using the table I showed you a little while ago, R bar would simply be 23% plus 33.4 plus the 28.6 plus the 21, all divided by 4 periods, and you get that 26.5% arithmetic average. And I showed you that. It shows in the table that I gave you a minute ago. Okay. Now keep in mind, there's a little subtlety here. I have expected return, and I'm using that and calling it the average return here. You need to be somewhat careful as you go through the world of finance. It's not just our textbook, it's not just me, but it's really the world of finance. There's a concept called expected returns and R bar. They're going to be used kind of interchangeably throughout the course. You're going to have to be careful of the context it's discussed in. Often expected returns are forward-looking. It's the return that you expect to get in the future. That is a valid interpretation. So you're looking at what's called ex ante, before the fact. Okay, it's kind of like in poker, you ante up, and so you ante up before the game starts, before you start, with the handing out the cards. And so you can think of it that way. We can also use it as a representation, or try to estimate this return that we expect to get in the future based on past returns, or returns that we call ex post, after the fact. And that's often the R bar. So here I'm calculating an R bar, and I'm saying, look, over the last 4 years, what did I expect to get? What did I get on average as a measure of central tendency? And that's what the arithmetic average does. And I get a 26.5% return as an R bar. So I could use that 26.5% as an estimate for my expectation next year. What else do I have to I don't have a crystal ball, so I look backwards over 4 years to try to project forward. It's not theoretically the right way to go, but it's all we have in finance, and it's what people do in general. Technically, you're supposed to look at all the information going forward and try to project what the return would be without looking backwards here. And we'll talk about we'll talk much more about this in depth when we talk about efficient markets. But actually, if I'm looking back and using historical data to try to get a handle on what the future will look like, I'm driving my car looking through the rearview mirror. And as soon as there's a change, I'm going to drive off a cliff, and this won't be relevant. So you need to be careful of it. And I'll be talking about this throughout this semester. Okay. The other type of average return that's out there is called a geometric mean, or a compound average return. And geometric means and compound average returns are important in finance because money compounds, and we need an average that reflects that compounding. And so when you take arithmetic, to go back to arithmetic for a second, we added things up and divided. When you take compound average returns, you're going to multiply the holding period returns. Multiply. And then we're going to have to take it to an exponential power to basically do the division on it. And to come up with an average geometric return, a compound average return. And so the formula for geometric mean is your holding period return, say for period 1 or year 1, times your holding period return for period 2, times your holding period return for period 3, and keep doing that for however many holding period returns you have. Okay, and take it to the 1 over n power. Okay, subtract the 1 and you'll get your return out of it. Okay, so it looks kind of ugly, but it's really not that bad, and I'll show you how to do it for large company stocks. So let's calculate the geometric mean for large company stocks. We're taking the whole holding period return for year 1, which is 1.23, so that's the 1 plus the 23% return that comes out of table 1 for large company stocks. Multiply it by 1 plus the 33.4% return, or what your textbook calls holding yield, 33.4%. Multiply that out and continue. Okay, so multiply those holding period returns, take it to the 1 over 4th power, because, sorry about that, 1 over 4th power, it's basically dividing, but we're and subtract out the 1, and we'll get 0.264, or 26.4% as the geometric mean. Now notice that's slightly different than the 26.5 we got with arithmetically. And they'll always be, almost always be close. They'll in fact be identical. If your returns are constant over time, these two numbers would be the same. And what I mean by constant is year 1 you get 10%, year 2 10%, year 3 10%, year 4 10%, and so on. Then you'll get the exact same arithmetic and geometric average, which would be 10%. It's only when you have variability in your returns that the two deviate. And we do have some variability here, not a whole lot. We don't even have any negative returns. So you got 23, 33, 28, and 21. They're all relatively high. And you'll learn that, that returns this high are fairly unusual. The average return over the past 80 years has been in the ballpark of about 11–12%. And to get these types of returns is fairly unusual, and get them consistent like this. We'll be talking about that, this concept throughout the semester. Okay. Now, one other thing, we will use both of these types of returns throughout the semester. The arithmetic is probably it is very useful. It's what you saw in your statistics class. So when you had a normal distribution and you're trying to make inferences around some statistical process, you would also often use an arithmetic average and figure out the probabilities associated with returns on this axis, or X, or whatever it was in your statistics class. It requires an arithmetic average. So this works with central tendency in statistics. This doesn't work that well. Geometric means don't work that well as a measure of central tendency in statistics. But it's nevertheless useful because money does compound over time. Okay. Now, let me ask you this. Given the information I just presented, let's say, I ask you this. What if I was to invest $10 at the beginning of year 1 and hold it through year 4? How much money would I have for large company stocks? So I invest $10 in large company stocks. I earn a 23%, 33%, and so on. How much money would I have at the end of year 4 using this data? Well, it's basically, look, I got $10, and I'm going to take the holding period return, the average holding period return, as 1.264, okay? And I'm going to take it to the 4th power because I'm getting 26.4% on average, right? And I'm going to take it to the 4th power, and I'm going to come up with 24 $25.53 when I do that. And so it's just an application of the information I used and where you can, find usefulness in geometric returns. And here you have it. Now, you've seen this before. You had to have seen this before in your previous finance course. It may be slightly disguised. In that class, you probably saw it in this context. This was a present value, right? This is an average return that you've used, and then this would be N, and this would be a future value. So you invested at year 0. You invested $10 as a present value. It's what it's worth today. And after 4 years, the whole thing is worth $25.53, given that you have a 26.4% average return. And that is an average total return. I should be clear, because this 26% in the data that I have here, these returns are total returns, which are really what's the most important in finance. We're not concerned about just the capital gains and losses. We're also concerned about cash flow. And so we're looking at total returns. And so if we invest $10, we're going to end up with $25.53 the end of 4 years, given this average return of 26.4%. Okay. Now, that's it for returns by themselves. Let's introduce risk, and then we'll introduce risk, and after that we'll get into combining risk and return, because all of finance boils down to risk and return. I don't care if you went through your undergraduate program in finance, or you go through a master's program and you deal with finance, or you get a PhD in finance. It all boils down to risk and return. And so let's look at risk, and then I'll combine the two. Okay. Our measure of risk is going to be how volatile a particular stock is, for example. I'll use a stock as an example. And what I'm going to do here is I'm going to, we're going to have stock returns, and let's assume the stock returns are variable. They wiggle around over time. They're up, they're down, and so on. And so you can calculate an average return, right? There's your average return. Over time, it's going to cut things right down the middle. And this variability is what we want to capture. So this is a fairly volatile stock. It's risky because it deviates from what you expect, your expected return. So if you see a return that looks like this, then on average you would have this measure of central tendency. This is what you would expect. This is a deviation from what you expect. This is a deviation from what you expect. And so what we want to do is take these deviations and use them to get a measure of volatility, which is a measure of risk for us. And the way we do that is we calculate variances, just like you did in your statistics course. And so let me give you the formula, and then I'll explain it to you. Okay, so that's the formula. And what this is saying is, look, we're going to take the deviations from what's expected. In other words, the mean, basically. And we're going to square them, because if we didn't square them, these negative deviations and these positive deviations would net to zero, and you wouldn't get anywhere. So you have to square them. And we're going to sum them up. So we're going to take this deviation, which is negative, we're going to square it, and then add it to this deviation that's been squared, and this deviation, and this, and this, and this, and so on. Add them up. That's what the sigma is. I years, 1 through n years, across over time. And then we're going to average these squared deviations. The sum of the squared deviations get averaged by dividing by n. And that's our measure of risk. So the more risky a stock, the higher the variance is going to be. So we're going to use variance in this course. We'll also use the square root of variance, which is called the standard deviation, or often called the volatility of a stock. So let's calculate the volatility of large company stocks from the table of information I gave you. So that's not too hard. we're just going to take the deviations from the mean. So from the arithmetic mean now, I should say. This is the arithmetic mean because it's a measure of central tendency that works great with statistics, like I said earlier. And this is another statistic. So we got the 23% for the first year returns minus the 26.5 average. We're going to square them. That's the first year deviation squared. The second year deviation is this square, and we're going to keep doing that for the 4 years. And we're going to divide the whole thing by 4 because we're looking at 4 years worth of data. When we do that, we come up with a variance of 23.63. Now, be careful here. It's not percent. It's percent squared because we're dealing with returns that have been squared in each case. So I like to put this to make it clear. Percent. You'll never find this in any textbook or anywhere else. It's only my own way of writing things down, just to highlight and basically scream at you that variances are in returns squared. They're not the original units, and so I put the double percent sign behind it. When you take the square root of the 2363, you'll get 4.86. And then you can put a single percent behind that. And now you're back into original units. So now you can compare this measure of volatility with the actual returns. Okay, because you're both on a percent basis. Okay. So the higher this number, the more risk you're taking, and all else being equal, the riskier the stock, the more you want to stay away from it, all else being equal. If you have a T-bill, a risk-free investment, right, there are no deviations from the mean. There is no wiggliness around this average. That doesn't exist. It's only this, meaning what you expect and what you get are identical. That's why it's risk-free. There's no variation, so each of these deviations is 0. And so your sigma will be 0 with a risk-free T-bill. Okay. Now let's look at the combination of and the blending of risk and return, because really what we want to do is we want to look at the two in combination with each other. There are several ways of doing that, that to try to get a handle on risk and return. And the first one is through a method called risk premiums. And so we're asking ourselves, how much return are we getting just for the risk that we've endured? And that's what a risk premium is all about. And so a risk premium is calculated by taking the return on a risky security, call it capital R, and subtracting out the risk-free rate. I'll call it capital RF for the risk-free rate. And so this is what I'm going to call I'll call it RP for risk premium. So for large company stocks, let's use it as an example. This was on average, so you can use averages here. You don't have to use averages. You can do this on an annual basis. You can do this on a daily basis. But if you do it over a period of time, you can use averages. And I'm going to use the arithmetic average, 26.5, minus the T-bill. This is the Treasury bill average T-bill rate that's found in the table I showed you, and that was 5%. So the risk premium is 21.5%. So how do you interpret that? Well, here's how it goes. You earned, if you invested in large company stocks for the last 4 years, you earned 21.5% simply for taking on the risk associated with large company stocks. The opportunity cost or the interest rate costs of money is reflected in the 5. We backed that out. So you earned 26.5. 5% had to do with the opportunity cost of money and interest rates, because you took money out of an account somewhere to buy these stocks, and that's 5%. But you also gained 21.5% for the risk you've taken. Now, I've presented this risk premium in an ex post context because I looked backwards at the last 4 years of data that we had. Risk premiums are often looked at going forward on an ex ante basis. So keep that in mind. Now, one other thing, the table of data that I gave you is, I told you it was real data. It is real data. It covered the period from 1996 to 1999. So it was 96, 97, 98, 99. It is real data. You might ask, well, why did I go back to this ancient history? I did it for a reason. This is data from the dot-com bubble, the surge in stock prices that took place in the late 1990s. And it tells that there's a story behind it and the reason why I picked it. And here's why. So we looked at stocks, and we can also look at long-term bonds, which are in that table I gave you. And we can look at the averages, average return. We can look at the volatility. And we calculated this to be 26.5 and this to be 4.86. Okay, so we just calculated that. If you did the same calculation, calculate the average return for long-term bonds, you would get a 4.77% average return with a volatility measure of 8.9%. And so, like I said, I have a reason for picking this data, and it's to ground you in the fact that, look, on an ex-ante basis, before the fact, stocks, you expect a reasonably high rate of return on stocks, but you also expect a reasonable measure of risk and volatility associated with it. With bonds, you expect a lower rate of return and a lower amount of risk. Okay, that's ex-ante, before the fact. You don't know what's going to happen, but that's what you expect. Ex-post, after the fact, anything could have happened. And that's the point of what I'm showing you here. Look, the stock market did really well. It's more than double what it typically does on an average year over the past 80 years, being 11 or 12% on average. It's 26.5%. It was a strong stock market back then. In fact, it was, some people call it the dot-com bubble, and we'll talk about what bubbles mean later in the course. But it had a high return, and those returns were relatively stable. There was no negative numbers there. So it was relatively stable, so it had a low standard deviation. Long-term government bonds returned a decent amount, nowhere near as high, but look at the amount of risk. Those returns were significantly more volatile than stocks. So the point is, be careful. You expect before the fact that bonds will be less risky and have a lower rate of return, but it's not always the case. Things happen ex post, anything can happen, and that's what risk is all about. Okay, so that's risk premiums and just a comparison. So when we talk about risk premiums, we're trying to compare returns and risk and trying to embed the two together, and that's what we're doing there. There's another more concrete way. I mean, this is a good way. You'll see risk premiums talked all over the world of finance, but there's another even more concrete way of dealing with risk and return, and that's in a concept called risk-adjusted returns. So I'm going to take returns and I'm going to risk adjust them. And the formula for that, let's get right to the formula, risk-adjusted returns, RAR, and I don't believe this is in Chapter 1. But it's very important that we look at risk-adjusted returns. We'll be talking about them throughout the semester, and it's how I'm going to rank your stock track portfolios. Your stock track portfolio at the end of the semester will be ranked on risk-adjusted returns. So let's look at this. So risk-adjusted returns, we're going to look at it on an ex-ante basis. So we're looking at the arithmetic average return, say, for large company stocks, minus the risk-free rate. So what do we have on top here of this fraction? It's the risk premium I talked about a minute ago. And it's risk premium adjusted for risk. And so we'll be able to measure, a risk premium in units of standard deviation. So we have all the numbers we need to compute this risk-adjusted return. So this will be 26.5, this will be the 5, and this will be 4.86 for a risk-adjusted return of 4.4 4, 2. Now, do not put, see this, I'll put a big X. Don't put a percent behind there because it's technically not a percent. It's unitless. And the reason why it's unitless is, look, you got a percent on top here, and this is a percent. So if you got percent on top and a percent on the bottom, they cancel out. And you get a number here, all right, but you don't have a measure, a unit. So don't refer to this as a percentage. It's kind of deceiving because it says risk-adjusted returns, but this is not really a return here. All I'm saying is you want this number to be as high as possible this semester. You want to have a really small volatility for your portfolio relative to how much relative to your risk premiums. You want a really big risk premium. You want this guy to be as big as possible, which means you earn a really great amount of return over the risk-free rate. You want a little volatility as possible, so you want this number to be as big as possible. And the student with the highest risk-adjusted return will be the winner, so to speak. You'll get some bonus points in the final exam. And the second place winner will get some too, and the third place. And the all-time loser, by the way, will also get points, provided they give a presentation at the end of the semester on what went wrong. So let's do a calculation. So let's do a calculation of the risk-adjusted returns. Another one, more practical. So let's do a more practical risk-adjusted return calculation. So I have an example on page 6 of my notes for chapter 1, and it says, assume your portfolio balance in stock track over each of the past several weeks has been $1 million, $1,020,000, $1 million again, then $980,000, then $1,040,000. And the risk-free rate over the period averaged 1%, as found in the Wall Street Journal. Compute your risk-adjusted return. Okay, so how do you do that? First of all, notice I didn't give you any returns. All I gave you was your portfolio balances. So you can look at it this way. You got week 1, 2, 3, and 4. And then you have a balance, okay? We had a balance. I'm going to chop the last 3 zeros off of everything because I don't want to deal with them. So we had 1,000, which is really $1 million. So I chopped off the last 3 zeros, got $1,000 for a balance, and then your portfolio went to 1,020. $1,020,000, and then it dropped down to 980. Nope, it dropped down to $1 million. Okay. And then it went down to 980. 1, 2, 3. Yep, there's a fifth period. There's a fifth week here. And then it goes to $1,040,000. Okay, so you got this portfolio. You had a capital gain. I should say you had a total return in dollars now, not percent. It's 20,000. Then you had a capital loss. I should say the total return, negative return of 20,000. Then you lost another 20,000, then you gained 60,000 here. So what we need to do is translate these into returns. So these are total returns because it reflects all, the capital gains of all the stocks and bonds and whatever else that's in your portfolio, all the interest income, dividend income, it's all included in there. So it's a total return. And so we need to compute. So it's total return in dollars. We need to put it on a percent basis. And so using the calculation for return, just like we did, you can think of this as a holding period return, or basically minus the 1 is the yield. Okay, but that terminology is not going to be used here. So I'll just show you. Look, the total return is going to be the market value of your portfolio at time 1 minus the market value at time 0 divided by your market value at time 0. It's another way of calculating your return. So this will be, so the first period will be 1,020,000 minus 1,000,000 divided by 1,000,000. So that'll be 0.02. Okay, that'll be 2%. You can keep doing that each period, and you will get, let's see, you'll get 2% here. Oops, put it here. You can't really calculate anything for the first period because you don't have enough data. So you start here at period 2, and looking back, you earn 2% for this time period. Then for this time period, you lost 1.96, not quite 2%. So do the math. You went from 1,000,000 here. I'll show you 1,000,000 from 1,020,000 divided by 1,020,000, and that'll be 0.0196. And then keep filling out the table. This will be 2% again, and then this will be, ooh, we had a good period, 6.12% total return. Okay. Now the average, add these up, the arithmetic average would be is 1.04%. So add these up and divide by 1, 2, 3, 4 periods, and you'll get, you made a little over 1% per week on average, is what that says, based on your balances in stock chart. Now, what we want to do is we need to calculate the deviations of the mean. We want to know how volatile this is. And you can see there is some volatility. You got some big positive number here. You got a negative number. So you're going to have some volatility. So what we want to do is calculate the return minus the average. And then we're going to square them. Okay. So what we're going to do is we're going to take the 2 here minus the 1.04, square it, and we get 0.92. And then we're going to take we're going to take this minus 1.96 minus the 104, square it, and we'll go to get 9. And then we'll do the same thing. And so we're going to have return squared that we're going to add up. If we add this up, we get 44.96 divided by 4, and we get a variance of 11.4, and that's percent. Take the square root, we'll come up to 3.35% as a measure of volatility. That's our sigma, right? This is our R bar, okay? And the average risk-free rate is the only thing that's outstanding. So let's put this together. Remember, our risk-adjusted return is nothing but R bar minus the risk-free rate on average over the time period divided by sigma. We got this to be 1.04, the average weekly return. The risk-free rate we need to calculate, we calculated already sigma to be 3.35% a second ago. Now what is this number? Well, the risk-free rate on average was 5%, but that's on an annual basis. We're on a weekly basis because our portfolio balances were done each week. So we just need to take that 5% and divide it by 52 weeks. And so your risk-free rate on average is 0.01923% per week. Okay? So this gives us a 0.305 risk-adjusted return. Again, don't put a percent sign behind there. Do not do that. It's unitless measure. All you want is you want this number to be as high as possible, because it means for every unit of risk that you've taken, you earn a giant risk premium associated with it. So what this says is for every unit of risk that we've taken, we've earned 0.305% risk premium on it. Now, what type of risk did we take here? Sigma is a measure of volatility. It's a measure of total risk. And by total risk, I mean it's a measure of systemic risk, and it's a measure of idiosyncratic, company-specific type risk. And so we need to look at this concept a little bit more. It is discussed in Chapter 1, believe it or not, of your text. I'll talk about it because it's going to keep popping up even before I present it formally in later chapters. So let's capture this idea of total risk using a formula. And so we have total risk equals systemic risk plus, I'll call it non-systemic for the minute. This is often called idiosyncratic risk, company-specific risk, okay? And systematic risk is sometimes called macro risk, market-wide risk, sometimes it's called market risk. So different names for each of these components. Be careful. This terminology is used throughout finance. There's no clear way of describing it. They can call these components any one of these names. So we have total risk of systemic and non-systemic. So let me show you graphically what I mean, and why we're decomposing things into these components. So here I'm going to have total risk, and sigma measures total risk. So this guy right here is measured by total risk. Your systemic risk is measured using a variable called beta, which I'm going to talk about in a second. And then what's left over is non-systemic risk. So let me show you graphically. So here we have total risk on this y-axis, and on the x-axis we have the number of assets in a portfolio. Think of it as the number of stocks in a portfolio. And so when we have one stock in a portfolio, and you can have a one-stock portfolio just like you can have a one-word sentence and a one-sentence paragraph. You can have a one-stock portfolio. That stock portfolio will have a lot of total risk. And as you start forming portfolios with more stocks, you randomly select those stocks, and that's important. You randomly select those stocks. Then your total risk starts to come down. It comes down, but it's not eliminated. As you can see, I didn't go to 0. So this would be 0 for a standard deviation. That's where your T-bill rate would be. Your risk-free rate would be there. At this right here at this point, 0. But with stocks, you'd have a lot. With an individual stock, you'd have a lot of total risk, but you'd have a netting effect because as you add stock, randomly select stocks to your portfolio, the stocks are subject to different types of risk. General Motors is exposed to a different type of risk than Apple, than is Motorola, than Applied Materials, and so on and so forth. And so they're subject to different types of shocks and news, and so there's a netting effect. So positive news in General Motors may be coming at the same time it's negative news for IBM and so forth. So we get this negative effect. And as we form portfolios and we get bigger and bigger portfolios, and as you move out in this direction, you eventually will look like the market. If you have a portfolio big enough, you'll hold all the stocks in the world that are out there, the universe, as we say, and you would start to look like the market. And we use the S&P 500 typically as the market, as a benchmark for the market. And you know the S&P 500 bounces up and down. So therefore, you need a measure. You're still going to have a measure of risk for this area right here, for this distance. And so that's going to be market risk because the S&P 500 will not have any company-specific risk, which is measured here. So I'll stripe it out here. This area right here is company-specific risk, and this is market risk. So in other words, this is your non-systemic, and this is your systemic risk. Add the two up, and you get your total risk. So what happens is, as you add more and more stocks to your portfolio, you get rid of idiosyncratic, company-specific, non-systemic risk. Washes out. And all you're left with is market risk. And market risk is macro in nature. It's the things that affect everybody. It's interest rates, it's foreign currencies, it's inflation, things that the President of the United States deals with, things that the Chairman of the Fed and the Federal Reserve Bank deals with. Those are macro market risks. And our measure of that is beta. A measure of this component right here is beta. And our measure of total risk is standard deviation. And what's left over is this striped area here. Okay. So now we go into some basic finance theory, which again, like as I said, I'll elaborate on as we get further into the textbook and into the course. But if you recall from your basic finance course, if diversification, if there's no transactions costs, and today's transactions costs are really low, there is really no costs to diversification, which means you can move out in this direction quite easily without much expense. And so what it boils down to is that, you know, there's no reason for you to take on extra risk from holding undiversified portfolios. So as you move out here, you get more diversified portfolios, you cut risk, but at the same time you keep expected return, and that's important. With these diversified portfolios, you get rid of risk through a netting effect, but the expected return still remains. You don't have a netting of expected returns, okay, like you do with risk. And so what we're dealing with is, right now we're dealing with what's called the capital asset pricing model. And the capital asset pricing model employs beta, which is a measure of systemic risk in the market. And we're also talking about what's called the security market line. And I'm going to graph this out in a second. But beta measures, it measures how does a stock or a portfolio of stocks covary relative to the market. And that's our measure of systemic risk. Now you got to be careful, and we'll talk about this later in the course. What does this model, this CAPM beta security market line model, imply? Or, you know, what's the underlying assumptions? Well, the underlying assumption is this, and you need to always keep this in mind. Nearly everybody forgets this, especially people on CNBC, the Wall Street Journal, when they talk about beta and the security market line and capital asset pricing model, is that this model assumes that everybody in the world is unemployed, meaning they don't have any labor. They're retired, basically. There's no more labor income. And that we don't own any housing. We have no real estate. If you own real estate, you're exposed to risk. If you have a job and you have labor income, that labor income could move up or down depending on the industry you're in. And so you have labor risk. And so what this beta measures is, it measures your risk relative to the stock market and the stock market only. Not relative to your labor risk and not relative to the real estate market. It's relative to the stock market in general. There are attempts of people to try to estimate betas that incorporate labor volatility, that incorporate volatility in real estate prices. But most of the time you see beta, and you go to various websites, and we'll do this all semester, is you're going to find a beta relative to the stock market. And that means your only income, your only asset that you have is stocks. So you're retired, living off the wealth of your portfolio of stocks, and you have no real estate, so you're basically renting. Nevertheless, you know, given that, and there's no agreement whether or not this model works, it is still very useful as a starting place to talk about portfolio risk and theory of portfolios. It is a extremely valuable model, which is why it shows up in nearly every textbook on investments. So let's graph this relationship. And the relationship looks like this. We're going to have beta on this axis, and we're going to have expected returns. So we're looking, when I say expected returns, I'm thinking in the future. What do I expect over the next year? And so I want to graph the security market line, and it's going to look something like this. This is the security market line. And I'll tell you why it's security market line in a second. This is the risk-free rate. So it says if you have a beta of 0, right here, you have a beta of 0, you have no systemic risk, which means you should be earning the risk-free rate. If you earn no risk, you just have, your investment has no risk, you should just be earning the opportunity cost of money, which is the T-bill rate. A treasury bill doesn't vary with anything or the market. And so you get this return here. Now, as you take on risk and you move in this direction, you're going to get some return. This is basically, here is a risk premium. It's the expected return minus the risk-free rate. This is a risk premium here for taking on risk. Now, why do they call it the security market line? Because it goes through the market portfolio, the S&P being an example. Come down over to here, label this M. And so this would be the expected return on the market, and this would be a beta. Now the market beta is defined to be 1. And we'll mathematically calculate that in a later chapter. But basically, when you have a beta of a stock of 1, it means the stock has average risk. It matches the market, which is the market is an average stock, basically. You think of the S&P as representing the average stock in the market. If you have betas that are higher, you know, maybe you're in high tech, you're in biotechnical stocks, you're going to have higher betas, you're going to have more risk, and the further you come out here somewhere, you come up and bounce over in this direction. So I'm going this way. You come up and over, you're going to get a higher expected return. Now, this is again on an ex-ante basis, it's before the fact. But historically, this is often around 12%, maybe 11%. And so it helps you to you know, it gives you a more concrete example of this theory if I put some real numbers in there. So this, in today's world, this risk-free rate is around close to 0. Treasury bill rates are almost 0, so if you round, they are 0. You round to the nearest percent. And so here you have a 0 risk-free rate, and so everything, just 12%. So basically, if this was 0, I should be drawing it right through the intercept, by the way. And the way I have it drawn, it looks like it's a positive number, like maybe 1%, but it's basically 0. And so this is a model that shows you risk measured by systemic risk only. There's no company-specific risk, so we're looking only at diversified portfolios because, as I said before, there's no reason for you to hold an undiversified portfolio. There's no reason for you to bear company-specific risk. You're not going to be compensated for it. So this tells you the more systemic risk you take, then the more expected return you're going to get. And the model, the equation for this graph is it's your expected return on the stock equals the risk-free rate, covers the opportunity cost of money, plus beta times the expected return on the market minus the risk-free rate. That's the formula for this graph and the security market line. So, off the top of my head, let's do an example. The risk-free rate, if you go to the Wall Street Journal or CNBC websites, or nearly any website, it's going to be about, I should say squiggly, let's say it's 0.1%. It's really low, 0.1%. So instead of putting 0 in there, let's put a number to it. And if we look at the beta for a particular stock, you go to finance.yahoo, you go to the wallstreetjournal.com, you go to cnbc.com, and then like 3 million other websites, you'll come up with the betas of company stocks. So let's say we pick, let's say we pick Apple. And let's just assume that Apple has a beta of 1.0. Let's say it's like 10% more risky than the market. So when you have a beta of 1.10, it means that you have market risk plus 10% more. So you're 10% more risky from a systemic point of view relative to the market. If you had a beta of 0.90 here, you'd be 10% less. You'd have 90% of the risk of the market, and so on. So that's how you interpret it. So we say that Apple's 10% riskier than the market as a whole. Okay. So what would we expect for a return on Apple? Well, if we put the numbers together, we have to come up with an expected return on the market. Well, I don't have a crystal ball, so I don't know what that number will be. All I can tell you is the average over the last 80 years has been 12%. And in fact, for 2014, it was around 11.4, I think, 11.4%, depending on the index you're looking at. So it really wasn't too bad to be able to predict that. So when you ask me, at any given time, I don't care what semester, what year we're in, where we're at, I'm always going to benchmark around 12% for an expected return on the market. So let me put it in. So now let's do the calculation. So the risk premium, so the opportunity cost is almost zero. It's really low. Interest rates are low. Now, the risk premium on the market, this is the market risk premium. It's basically covering from here to here. Graphically, from here to here is the market risk premium. And that happens to be, this market risk premium right here is 11.9. Let me get rid of this decimal. I don't like this decimal here. We don't need these decimals. Get rid of those decimals there. And, but I do need, sorry, I do need this decimal. I do need that decimal there, but I don't need a decimal in front of the 12. Everything's in percent here. Everything, you put a percent sign in here. So it's 12 minus 0.1 is 11.9 is the market risk premium. So if you hold the market is measured by the S&P, your risk premium, according to what I have here, is 11.9%. So how do you actually, by the way, how do you actually get a position in the market? Well, it's easy. You could, one of two ways. You could quite easily go to the web, go to, for example, Vanguard.com, go to Fidelity.com, and a host of other mutual fund complexes, and you can get into a mutual fund that mimics the S&P 500. They're called index funds that are designed to mimic the S&P 500. And it's quite easy to do that. You can also buy what's called exchange-traded funds that mimic an index like the S&P 500. We'll talk about these concepts throughout the semester because it's very important, and you can actually duplicate this in StockTrack. You can actually buy exchange-traded funds in StockTrack. You can buy mutual funds in StockTrack. So with one click, not 500, with one click you can take a position in all 500 stocks of the S&P is what I'm saying. So it's really easy to diversify and relatively low cost. So let's multiply this out. This is 0.10 plus 13.09. And so this is 13.19%. The return that I expect to get on Apple is around 13.2%, approximately 13.2% for Apple. And that's how you would apply this model.